Ever pondered on the structure of a currency pair in Forex trading? Well, it's a fascinating world, and today we'll delve into its anatomy. A currency pair, you see, is the quotation of two different currencies. It tells you the relative value of one currency against the other. Now, the structure of a currency pair involves understanding the base and the quote currencies, each playing its unique role. First, we have the base currency. This currency is the first one listed in the pair and serves as our reference point for determining the exchange rate. Take EUR/USD for instance. Here, the euro is our base currency. Next up is the quote currency. This is the second currency listed in the pair, representing the value at which one unit of the base currency can be exchanged. In our previous example of EUR/USD, the US dollar is the quote currency. Now, currency pairs can be broadly classified into major pairs and minor pairs. Major pairs involve major global currencies like the US dollar, euro, Japanese yen, and British pound. These pairs often offer more liquidity and lower spreads, influencing short-term trading strategies. On the other hand, minor pairs comprise currencies from smaller economies. While they may have higher spreads, they can offer unique trading opportunities and are influenced by different economic factors. Then we have cross pairs. These pairs don't involve the US dollar. Traders need to consider multiple economic factors from the respective countries, providing diversification opportunities. For instance, EUR/GBP or AUD/JPY. The strength or weakness of the base currency is another key consideration for traders. If the base currency is expected to strengthen, a trader might initiate a long position. Understanding macroeconomic indicators and geopolitical events affecting the base currency is crucial. Economic indicators and interest rates of the countries involved also influence currency pairs. Central bank decisions and economic data releases can significantly impact trading decisions. Traders often look for divergences in economic performance between the base and quote currency countries. Correlation analysis is another tool in a trader's toolbox. Correlations between currency pairs, whether positive or negative, can affect risk management and portfolio diversification. Volatility and liquidity too vary across currency pairs. Majors usually have lower volatility than exotic pairs. Traders may adapt strategies based on their risk tolerance and preference for volatile or stable markets. Finally, some traders might engage in carry trades, where they borrow in a low-interest rate currency to invest in a higher-yielding currency. This strategy is influenced by interest rate differentials between the base and quote currencies. In sum, the composition of a currency pair is a critical consideration for traders. Understanding the base and quote currencies, their economic fundamentals, and the broader market dynamics can help traders develop informed strategies tailored to their objectives and risk tolerance.